What is Keynesian economics? Keynesian economics is an economic theory that emphasizes demand as the primary driver of economic growth. It argues that fiscal support is necessary to help economies recover from recessions, contrasting with classical economic theory. The theory, introduced by John Maynard Keynes in the 1930s and formalized in his 1936 work The General Theory of Employment, Interest, and Money, asserts that government spending plays a crucial role in boosting demand and ensuring full employment. Keynesian economics is based on several core theories. Aggregate demand is influenced by various public and private factors, with monetary and fiscal policy playing a key role in determining its level. Unlike Say's law, which states that supply creates its own demand, Keynesian economics argues that demand drives supply and economic growth. The concept of sticky wages suggests that employers prefer layoffs over wage reductions, as workers resist pay cuts, and lower wages could lead to reduced demand and economic stagnation. Keynes also proposed that labor markets do not function independently from savings markets, leading to slow adjustments in wages and prices. The liquidity trap describes a situation where economic contraction persists despite low interest rates, contradicting the classical view that lower rates stimulate investment.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
Keynesian economics differs significantly from classical economics. While classical theory suggests that markets self-regulate and restore equilibrium without government intervention, Keynesian theory advocates for active fiscal and monetary policy to stabilize the economy. Classical economists argue that government spending leads to the crowding out of private investment by raising interest rates. However, Keynesian economics contends that deficit spending during a recession does not have this effect, as private investment is already weak in such periods. Additionally, while classical theory promotes minimal government debt, Keynesian economics supports deficit financing to counter economic downturns. The policy measures supported by Keynesian economics focus on countercyclical strategies. Governments should act against economic cycles, implementing short-term policies rather than waiting for natural recovery. Keynes' famous statement, "In the long run, we are all dead," underscores his belief that governments should prioritize immediate economic stability over long-term projections. The multiplier effect further strengthens Keynes' argument for fiscal intervention, stating that government spending can increase GDP by a greater amount than the initial investment, providing a strong rationale for fiscal support during downturns. Despite its influence, Keynesian economics has faced criticism. Initially, it downplayed the role of monetary policy, though modern Keynesian thought has since integrated it. Critics argue that the impact of fiscal policy on GDP is difficult to quantify, making policy adjustments challenging. Some believe Keynesian policies can lead to government spending on projects with vested interests, increasing corruption. The Ricardian equivalence theory suggests that temporary tax cuts do not boost spending, as individuals anticipate future tax hikes and save the extra income instead. Furthermore, supply-side economics emerged as a major challenge to Keynesian thought, particularly after the stagflation of the 1970s, when the Phillips curve failed to explain rising inflation alongside high unemployment. For more related videos, please subscribe to the channel and click the bell icon to get notifications.